Are you looking to start investing but feeling overwhelmed with all the options out there? Wondering how to make your money work for you? Today, we're diving into the basics of investing. Whether you're a beginner or looking to brush up your knowledge, this video is your guide to understanding the pillars of investment: stocks, bonds, and mutual funds. Investing is for everyone, regardless of age or background. It's about making informed choices to build a more secure financial future. We'll break down each investment type, explore their benefits, and discuss how you can start incorporating them into your financial strategy. So, grab a notebook, and let's get started on this journey to financial empowerment with WealthWise. Let's start with stocks. Stocks, also known as equities, represent shares in the ownership of a company. When you buy a stock, you're essentially buying a small piece of that company. The value of stocks can go up or down based on how well the company is performing and how investors feel about its future prospects. This is what makes the stock market dynamic and, at times, volatile. Think of stocks as a high-reward investment. Historically, stocks have provided higher returns than other assets like bonds or savings accounts, especially over the long term. But with high reward comes high risk. Stock prices can be unpredictable and can fluctuate greatly. That's why diversification, holding a variety of stocks in different industries, is key to managing risk. Another advantage of stocks is dividends. Some companies pay out a portion of their profits to shareholders, providing an additional income stream. While some investors trade stocks frequently to capitalize on short-term price movements, many financial experts recommend a long-term approach, focusing on steady growth. In summary, stocks can be a powerful tool for wealth creation. They offer potential for high returns, but also come with risks. Smart stock investing requires research, diversification, and a clear understanding of your financial goals. Now, let's talk about bonds. Unlike stocks, bonds are essentially loans that you give to a company or government. In return, they agree to pay you back the full amount on a specific date, known as the bond's maturity date. When you purchase a bond, you're lending money to the issuer, which could be a corporation, municipality, or government. The issuer promises to pay you interest at regular intervals, typically semi-annually. Bonds are often seen as a safer investment compared to stocks. They provide a predictable income stream through interest payments, known as the bond's yield. The trade-off? While bonds are generally less risky, they also offer lower returns than stocks over the long term. This makes them more appealing to conservative investors or those nearing retirement. There are different types of bonds, including government bonds, which are considered extremely safe, municipal bonds, which offer tax benefits, and corporate bonds, which tend to have higher yields but also higher risk. It's important to consider the bond's credit rating. This rating, given by agencies like Moody's or Standard & Poor's, indicates the issuer's ability to repay the bond. Higher-rated bonds are safer, but offer lower yields. Bonds come with different maturity periods. Short-term bonds can mature in a few years, while long-term bonds might take decades. The right choice depends on your investment timeframe and risk tolerance. In conclusion, bonds are a key part of a diversified portfolio, offering stability and consistent income. While they might not offer the high returns of stocks, they play a crucial role in balancing risk, especially in volatile markets. Finally, let's explore mutual funds. Mutual funds are like a basket of investments. They pool money from many investors to buy a diversified mix of stocks, bonds, or other securities. When you invest in a mutual fund, you're buying shares of the fund, and your investment represents a portion of ownership in all the fund's holdings. One of the biggest advantages of mutual funds is diversification. By spreading your investment across many assets, mutual funds can reduce the risk of losing money if a single company or sector underperforms. Mutual funds are managed by professional fund managers, who decide where to invest the funds based on the fund's objectives. This makes them a convenient choice for investors who prefer a hands-off approach. There are two main types of mutual funds: actively managed funds, where fund managers actively select investments, and index funds, which aim to replicate the performance of a specific market index. It's important to consider fees when investing in mutual funds. These can include management fees and expense ratios, which can vary widely and impact your overall returns. While mutual funds offer the potential for solid returns and are less risky than individual stocks, they're still subject to market risks. However, they can be a valuable part of a long-term investment strategy. In summary, mutual funds offer diversification, professional management, and are an accessible way for individual investors to participate in a wide range of investments. They can be a cornerstone in building a balanced investment portfolio. In summary, stocks offer high potential returns with higher risk, ideal for long-term growth. Bonds provide stable income and lower risk, suitable for medium-term goals. Mutual funds combine diversification and professional management, fitting various investment horizons. Remember, start with clear goals, understand your risk tolerance, and consider starting with mutual funds for diversification. Stay informed and adapt as you learn more about the market. That's a quick overview of these investment types. For more insights, subscribe to AussieWealth and explore our content. Share your thoughts and let us know what topics you'd like to see next. Thanks for watching. Here's to growing your financial wisdom with AussieWealth.